So, uh, what if I told you that a single, mostly forgotten government accounting error is actually the primary reason several of America's biggest retailers are avoiding completely disastrous earnings reports this week?
It's kind of wild when you actually look at the ledger.
Right. We are looking at a market right now, as of this week in August 2026, where the headlines are telling one story, but the underlying mechanics, they tell something completely different. I mean, we are seeing situations where the world's most valuable microchip company is essentially being forced to moonlight as a real estate matchmaker in the Arctic Circle,
Which is just...
just so its clients can keep their servers from physically melting.
Yeah, we are operating in an environment that is driven almost entirely by these hidden incentives and just really bizarre adaptations.
Yeah.
Because when the fundamental rules of money change, businesses don't just politely accept lower profit margins.
No, they scramble.
They do. They contort themselves to find a workaround. So that might mean a massive corporation leveraging this obscure Supreme Court ruling to subsidize its own inventory mistakes.
Right.
Or it might mean a local gas station building a secret cocktail lounge behind a soda cooler just to avoid going bankrupt.
Which is maybe my favorite story of the week.
Yeah.
But our mission today is to actually decode the mechanics behind those workarounds. We've got a whole stack of sources covering these financial anomalies, and we really need to understand the why and the how driving them.
Mm-hmm.
We'll start by unpacking the U.S. Treasury's, frankly, highly unusual intervention in the bond market. And then we will trace that billion-dollar windfall that is quietly propping up the retail sector.
Mm-hmm.
And finally, we'll look at the actual physical brick-and-mortar reality that's just crashing into the artificial intelligence boom.
Because the central thread running through all of the source material is really how both public institutions and private businesses are managing these severe physical and financial constraints.
Right. And to understand how these unseen levers operate, we kind of have to look at the largest lever in the entire financial system, which is government debt.
Yeah.
As of this week, the U.S. national debt crossed the $40 trillion milestone, which is just, that number is so large it almost loses its meaning.
It does. It sounds made up.
It sounds totally made up.
Right.
But the practical reality is that the debt has doubled in a single decade.
And the sheer scale of that borrowing fundamentally alters the math for the broader economy. To put it in perspective, during just the first 10 months of this fiscal year alone, the net interest payments on that $40 trillion debt hit $973 billion.
Wow. Just on interest.
Just on interest.
Right.
We are at a point where roughly 15% of all federal spending is dedicated solely to servicing interest.
Which brings us to the U.S. Treasury and Secretary Scott Bessent.
Mm-hmm.
The Treasury is clearly, feeling the weight of that debt burden. And they just announced an intervention that has the bond markets practically vibrating right now.
Oh, yeah.
They are actively increasing their buybacks of long-term Treasury debt. Specifically, we're talking about the 10 to 30-year bonds. And they are shifting those purchases from $2 billion to at least $4 billion.
And the immediate effect on the market was pretty striking. Prior to this intervention, we were seeing a massive sell-off in the Treasury market.
Right.
And that sell-off was driven by these lingering inflation fears and really just the sheer volume of government issuance. It pushed the 10-year yield up to a highly uncomfortable 4.74%.
Which is high.
Very high. But the moment the Treasury announced they were stepping in to take those long-term maturities off the open market, the yield fell right back down to 4.65%.
Okay, wait. I need to pause you here and just break down the actual mechanism.
No.
Because bond pricing is notoriously counterintuitive for anyone who doesn't trade them every single day.
It's completely backwards.
Right. So walk us through the actual physical relationship between the Treasury buying those bonds and the yield dropping.
Sure. So the foundational rule of the bond market is that prices move inversely to yields.
Okay.
Think of a bond as a piece of paper that pays a fixed dollar amount every single year.
Right.
When investors get nervous about inflation eroding their returns or, when the government just issues way too many of these pieces of paper, investors start selling them.
They want to get rid of them.
Exactly. And that flood of supply drives the actual price of the piece of paper down. But because that piece of paper still pays the exact same fixed dollar amount in interest, a lower purchase price means the effective percentage return, which is the yield, goes up.
Okay, let me make sure I have this straight.
Mm-hmm.
If a bond costs $100 and pays $5 a year, the yield is 5%.
Correct.
But if the market panics and the price of that bond drops to $50, it still pays $5 a year.
It never changes.
But now, because I only paid $50 to get it, my effective yield is 10%.
That is the exact mathematical reality, yes. So by stepping in as a buyer of last resort for these 10 to 30-year bonds, the Treasury is artificially reducing the supply of that paper on the open market.
Oh, so fewer bonds available means the price gets bid back up.
Exactly, which forces the yield back down.
Okay.
And they're intervening because high 10-year yields ripple through the entire consumer economy. I mean, that 10-year yield is the benchmark used to price 30-year mortgage rates.
Which recently hit, what, 6.75%?
Right around there, yeah. And it dictates the cost of corporate borrowing for almost every major company.
But the Treasury, they can't just print the money to buy these bonds the way the Federal Reserve does during, like, quantitative easing. They have to fund this $4 billion buyback somehow.
Right, and they are funding it by issuing more short-term debt. So
Yeah.
the Treasury is essentially replacing 30-year bonds with short-term Treasury bills, and those mature in a matter of months rather than decades.
That feels like a trap.
It is definitely a risk. The Treasury Borrowing Advisory Committee generally recommends keeping short-term bills to roughly 20% of total outstanding debt just to maintain stability.
Okay.
Right now, to fund these interventions, they have pushed that ratio up to 22.2%.
That seems incredibly risky. I am trying to think of a real-world equivalent here. It sounds a lot like a homeowner who is struggling with their monthly budget, so they decide to refinance a stable 30-year fixed-rate mortgage into a short-term adjustable-rate mortgage.
Yes.
Like, they get a lower payment this month, but they are completely exposed if interest rates spike next year.
The homeowner analogy is highly relevant here, though, we must extend it to the macroeconomic scale.
Sure.
When the federal government shifts its debt profile towards shorter maturities, its interest expenses become hypersensitive to immediate rate hikes.
Wow, so if the central bank raises rates.
Exactly. The cost for the Treasury to roll over and refinance that massive pile of short-term debt, it skyrockets almost instantly, rather than being safely locked in for 30 years.
That dynamic puts the Treasury on a direct collision course with the Federal Reserve. Because Fed Chair Kevin Warsh left interest rates in the 3.5 to 3.75% range back in July, specifically because inflation data is still showing sticky underlying pressures.
Right.
And Warsh has stated he wants an unfiltered, natural signal from the bond market to guide his monetary policy.
And the Treasury's intervention is actively distorting the very signal the Fed relies on.
Wow.
The Federal Reserve is attempting to keep rates elevated to cool the economy, while the Treasury is simultaneously stepping on the scale to artificially lower long-term borrowing costs.
So we are witnessing fiscal policy directly fighting monetary policy.
We really are.
And that tension between government action and market reality is not just confined to the bond market. It is currently tearing through the retail sector in a way that just completely obscures how businesses are actually performing.
Yes, the tariff situation.
Right. We are looking at a collision of two major tariff stories this week.
So the first story is the 11th hour diplomatic deal that was reached on Tuesday night.
Right.
That agreement paused a planned 50% tariff on roughly $20 billion of Canadian goods. So that's targeting autos, steel, and agricultural products.
And that tariff was scheduled to take effect mere hours later on Wednesday.
Exactly. It was right down to the wire.
But while that new crisis was averted, the fallout from an older tariff policy is unleashing just a tidal wave of cash. A Supreme Court ruling from earlier this year declared a set of older U.S. import tariffs unconstitutional.
Right.
And that specific ruling has triggered a retroactive $100 billion refund to American businesses. Analysts are actually calling it Liberation Day.
We should probably clarify the physical mechanism of a tariff here, because the political rhetoric often obscures how the cash actually flows.
Yes, please.
Tariffs are not paid by the foreign exporting country.
Right.
They are taxes paid directly by the importing American business at the port of entry.
Because the importing businesses paid those taxes, the unconstitutional ruling means the U.S. government now has to write direct refund checks to those specific corporations.
Exactly.
And when we look at the retail earnings reports crossing the wire this week, those refund checks are acting as a massive, entirely unexpected corporate stimulus. I mean, Target reported their second quarter operating income doubled to $2.6 billion compared to this time last year.
Which looks incredible on paper.
It looks amazing. But sitting right there in the ledger is a nearly $1 billion pre-tax tariff refund.
Yes, and Target is deploying that sudden cash injection offensively.
Yeah.
They announced they're lowering prices on 10,000 everyday items to win back market share from competitors.
Oh, wow.
However, other retailers receiving these refunds are taking a highly defensive posture. Take Lowe's, for example.
Okay.
They received an $80 million tariff refund. Their executive team explicitly stated they are holding on to that cash to protect shareholder profitability rather than cutting prices. Yeah, they noted that larger DIY home improvement projects are essentially just frozen right now due to extreme consumer caution.
And we have TJX, the parent company of TJ Maxx. They received a $331 million refund.
Mm-hmm.
And they used that cash to pad their overall earnings, which conveniently masked some pretty significant self-inflicted inventory mix-ups in their Marmaxx apparel division.
Right.
If Target's operating income only doubled because of a government refund check, it raises a serious red flag. Like, we seem to be confusing a bizarre legal accounting quirk with a healthy consumer base.
It's a huge smokescreen.
It is. By the way, if you enjoy pulling back the curtain on the actual mechanics of retail and markets like this, you can find more financial candy, brain candy, and classic audiobooks at clearnoratio.com.
But getting back to that red flag, the underlying financial data strongly suggests the consumer is fatigued.
Yeah.
When you strip away the tariff refunds, the underlying same-store sales growth for many of these major retailers is either flat or it's actually declining. Their profit margins are being artificially inflated by a one-time cash return from the government, not by organic consumer demand for their products.
While the retail sector is hunting for margin relief through these government refund checks, the technology sector is hunting for something far more tangible.
Yes.
The artificial intelligence boom has officially hit the hard constraints of the physical world.
The narrative around artificial intelligence is transitioning from a software story to a heavy industry story.
Okay, how so?
Well, the primary bottleneck for these tech giants is no longer writing the code or designing the algorithms. The bottleneck is securing the physical electricity, the industrial cooling infrastructure, and the raw silicon required to actually run the models.
And the desperation for that silicon is pushing companies to take some pretty extreme measures.
Hmm.
Like Google is currently attempting to break free from NVIDIA's highly expensive monopoly on AI chips.
Right.
They're buying up to $12.2 billion in shares of the chip maker Marvell to secure their own custom AI inference accelerators, which they call TPUs, or tensor processing units.
And the distinction between training an AI and running inference is critical here.
Break that down for us.
So training is the initial, wildly expensive process of feeding a model billions of data points so it learns how to think.
Right, that's the heavy lifting up front.
Exactly. Inference is what happens after the model is built, when a user actually asks it a question and it generates an answer.
Okay.
So Google processes billions of search queries a day. They do not need NVIDIA's massive, power-hungry training GPUs for every single search. They need custom TPUs designed specifically for highly efficient, high-volume inference.
And NVIDIA is highly aware of this shifting landscape, and they're adapting their own strategy. I mean, they're no longer just selling graphics processing units. Industry sources indicate NVIDIA is now actively operating as a real estate matchmaker.
Which is a crazy pivot.
It's wild. They are connecting the companies buying their GPUs with data center operators located in the freezing Nordics, specifically Finland and Norway.
And the energy requirements dictate this move. A modern AI data center consumes gigawatts of power and generates enough heat to melt its own components if it's not managed properly.
Oh, man.
So the Nordics offer abundant, undeveloped land, cheap, renewable hydroelectric energy, and a naturally freezing climate that drastically reduces the astronomical cost of artificial cooling.
That makes total sense.
Right. If NVIDIA wants to maintain its revenue growth, it has to ensure its clients actually have a physical facility capable of plugging the chips in without blowing the local power grid.
So if I am tracking this correctly, NVIDIA has essentially become a luxury car dealer who realizes their new sports car requires a highly specific, highly volatile type of rocket fuel.
Yes.
And because there are no gas stations that sell this fuel, the car dealer now has to physically pave a road for you in Finland and build a custom fueling station. Otherwise, you can't even turn the car on.
That is exactly it. The physical reality of the hardware demands that level of intervention, and we are seeing this exact same shift toward physical manufacturing constraints play out in the robotics sector, too.
Right, over in Shanghai.
Exactly. Unitree Robotics made its stock market debut this week on the Star Market, which is the Shanghai Stock Exchange's equivalent to the American NASDAQ, designed specifically for tech and science companies.
And upon listing, their shares surged over 460%.
It was a massive debut.
Yeah, because they are mass-producing humanoid robots that retail for roughly $13,500.
And that price point fundamentally changes the robotics landscape.
Completely.
They are severely undercutting their American rivals. You know, while companies in the U.S. have spent years building highly complex, multi-million-dollar prototypes designed to do parkour or backflips.
Right, the stunt videos.
Yeah, exactly. Unitree just entirely ignored the stunt engineering.
So how are they getting the price that low? $13,500 is like the price of a used sedan.
They achieved that price point by standardizing the components. Instead of engineering custom joints and proprietary actuators for every new model, they leveraged the existing consumer electronics supply chains in Shenzhen.
Oh, I see.
Yeah, to use off-the-shelf motors and simplified chassis designs. They prioritized mass production and basic utility over absolute perfection.
And the financial result of that approach is that they shipped over 5,500 humanoid robots last year and reported a net profit of approximately $39 million.
Which demonstrates that the next phase of the technology sector isn't just about who possesses the smartest software algorithm.
Right.
It is entirely dependent on who can physically build the hardware, secure the gigawatts of power for the data centers, and manufacture the physical components without bankrupting the company.
Because software scales infinitely and almost instantly. Physical infrastructure does not.
Exactly. The companies that master the manufacturing and energy constraints will dictate the market.
I want to bring these massive macroeconomic forces like the trillions in federal debt, the billion-dollar tariff refunds, the industrial energy constraints. I want to bring that back down to a microscopic human scale.
Oh.
We have to look at how a single independent business survives when operating costs are skyrocketing and corporate CEOs are reporting that consumers are too cautious to spend money.
The survival mechanism at the local level relies on a concept called margin cross-subsidization.
Okay.
We're seeing a brilliant, highly unusual application of this in Lakeville, Minnesota. A local entrepreneur took a failing Amoco gas station convenience store and transformed it into an enterprise generating nearly $5 million a year in revenue.
The business is called the Farmer's Cellar. The baseline convenience store operation used to lose roughly $10,000 a month.
Which is brutal.
Brutal. But today, the location is highly profitable. And the mechanism driving that profit is a high-end 1920s-style speakeasy hidden behind a faux soda cooler inside the gas station.
Such a clever idea.
It's amazing. A customer walks past the fluorescent lights and the racks of beef jerky, pulls open a specific cooler door, and steps into a room outfitted with leather chairs, chandeliers, and premium service.
And the underlying economics of the restaurant industry explain why this specific setup works so well. Over the past few years, baseline restaurant operating costs, so encompassing hourly labor, raw ingredients, and commercial insurance, have risen by approximately 36%.
Wow, 36%.
Yeah. A traditional restaurant model struggles to absorb that increase. To survive, a physical business requires a product with an incredibly high profit margin to subsidize the heavy, low-margin infrastructure of maintaining the building and paying the staff.
And in the case of the Farmer's Cellar, the high-margin product is the craft cocktail menu.
Right.
The bartenders are using industrial centrifuges and liquid nitrogen to create these elaborate drinks. So the customer isn't just paying for the alcohol, they are paying a premium for the theatrical experience of finding a hidden room inside an Amoco station.
Exactly. The speakeasy effectively cross-subsidizes the failing convenience store. On weekends, patrons line up for access to the hidden bar, and while they wait, they invariably purchase snacks, water, and merchandise from the convenience store. So the massive profit margins generated by the liquid nitrogen cocktails cover the fixed real estate and labor costs of operating the entire property. It turns the previously unprofitable retail space into a captive, high-volume waiting room.
This local story perfectly captures the strange duality of the consumer in August 2026. We look at a retail giant like Lowe's, and their data indicates people are too financially squeezed to renovate their kitchens or buy a load of lumber.
Yeah.
The consumer is pulling back on major physical goods.
Yeah.
Yet those exact same financially squeezed consumers will gladly stand in line inside a gas station on a Friday night to purchase a $20 cocktail.
Right.
We are clearly operating in an experience economy. The budget for physical merchandise is frozen, but the budget for a memorable premium escape is seemingly untouched.
And the behavioral economics support that shift. When macroeconomic pressures rise, consumers look for accessible luxuries.
Oh, accessible luxuries.
Yeah, a $20 cocktail feels justifiable when a $20,000 kitchen remodel is out of reach. The businesses thriving right now are the ones structurally designed to capture that specific, momentary willingness to spend.
Which brings us back to the most critical question facing the broader market as we look toward the end of the year. We are seeing businesses adapt to real estate matchmaking, cheap, standardized robotics, and hidden cocktail bars. But at the top of the retail chain, we are seeing balance sheets propped up by a $100 billion legal anomaly.
Right, the tariffs.
If those one-time government tariff refunds are temporarily masking the underlying weakness in organic consumer demand today, what happens to those massive retail corporations next year?
That's the million-dollar question.
When the refund checks stop arriving, but the elevated operating costs and the cautious consumer behavior remain, that is when we will see which companies actually built a sustainable business and which ones were just relying on an accounting error.
Absolutely. A structural illusion can only prop up an earnings report for a few quarters. Eventually, the baseline fundamentals of supply and demand reassert themselves.
We will continue tracking how those fundamentals shift in the coming weeks. Thank you for joining us for this analysis of the week's financial oddities. Keep an eye on those hidden incentives, and we will be back next time to decode the next set of signals.